So we had a little bit of a scare there. We don't know what's going to happen yet in the markets. We got like 55, 56 minutes left in the market. So, I mean, we'll see. I mean, obviously things are not looking as pretty as they did earlier today. And honestly, this really started when the Fed released their minutes. However, we basically hit some critical levels on the Qs and also on SPY. Didn't necessarily recover those moving averages that I was looking at for a little bit. And I mean, we're still in wait and see mode. I mean, it doesn't look like things are falling off a cliff, but we're going to go ahead and monitor the situation. Yes. I'm late. My bad. What's going on, people? What's going on? How are you? Everybody is tuning in. Let us go and get on with it. We're going to talk about a few things today, right? One, why did Warren Buffett sell Amazon? Now, I'm going to give my thesis on it and the reason why he might have sold it and the reason why a lot of these fund managers are really, I don't want to say liquidating their positions, but Peter Thiel kind of liquidating all of his tech stuff is kind of sus, right? But we'll take a closer look at some 13Fs over here. We'll figure out why Warren Buffett is selling. Now, I know it's not Warren Buffett, it's Greg Abel. So, we're going to kind of see the reasoning of it and the reason why he's making these moves. Also, we're going to take a look at ACLS. All right. So you got me, guys. The stock is 18% down today. I was trying to give the bull thesis yesterday. It didn't exactly turn out the way that I wanted. We're going to go through the earnings, see the reason why that happened. Also, we're going to talk a little bit about Palo Alto earnings because that's also down in the day. Now, that's a very big name that a lot of people are long, and that's cybersecurity. A very good thesis to be on, especially when it comes to AI. But this software fear is continuing to weigh down on a lot of great companies. So we're going to take a look at a few charts over there. We're going to do like a high-level view of those earnings as well and see what's going on there, the reason why it's down. I could probably tell you the reason why it's down, but we'll go ahead and just gander a little bit. Then we're going to take a look at Fintech. So Klarna reported earnings this morning in addition to another Fintech company reporting after hours yesterday. Fintech actually made a sizable bounce today. I don't know how it's looking like right now toward the end of the day. I haven't checked, but they were looking pretty good this morning, so we will see. And finally, we're going to have a little bit of a solid talk session. I like to throw some of these at you once in a while, but kind of give my thoughts as far as like where I think the market is going. Yeah, we're also going to take a look at the data center stuff. Slowly trending down again. Yeah, I mean, I don't know if this is like a dead cat bounce or anything, but you definitely having some leadership with Nebius over there, but we'll take a closer look at that one as well. So everyone, welcome to the Solid Report Show. Really appreciate you being here. We're actually going to have a special guest on tomorrow. Been back and forth with her a little bit. She's more of a trader, Danielle Shea, so I'm going to see if she can come on tomorrow, give her view of the markets, but congratulations to her. She was actually short Palo Alto yesterday for the close, and I'm sure that she's very happy with her with her gains over there. So Palo Alto is down about 7.5%. Excuse me, that one came out of nowhere. Maybe that was like a bear sneeze or something. But yeah, SPY is a little bit pulling back over here. Let me go ahead and share my chart. No, I am not the CEO of Wolf. I don't know why this thing keeps on saying I'm CEO of Wolf. That is Gav Blacksburg. Let me just throw my X over here real quick. So then that way you guys can see the correct one. There you go. Now we have the correct label. Let's go ahead and take a look at the markets right now, see where we're going at. Hopefully this doesn't fall off a cliff even further as we are going to head toward the market close. So we have the SPY over here. Like I mentioned, this did pull back a little bit. Was it a bull trap? Could we see some lower lows? Right now we have some support over here. We've bounced on it 1, 2, 3, 4 times. We did have a swing low over here last November, but we've continued to kind of make some tops over here. Now, I don't want to say this is entirely bearish, but we do want some follow through on the action that we see today. We've seen it happen many, many times. So this is the 100-day moving average. We found it at support 1, 2, 3 times. Yesterday, we had a massive recovery in the beginning of the day. At the beginning of the day, it looked like, hey, the market's going to fall off a cliff or continue to fall off a cliff, but that certainly wasn't the case. And we actually were up on SPY as high as 689 today, which would have had a decent recovery, but rejected the 20-day moving average over here, and we lost a 21 EMA on the chart. Let's take a look at the weekly chart over here. Not so bad. We did bounce off the 21 EMA for SPY. So we are... I don't know. Let's see how the rest of this week goes. But pullback that we saw here today in the weekly level, it's just, I mean, to be honest, this kind of looks a little bit toppy to me, only because you get all of these wicks facing up here. Also, you're not finding any momentum continue to the upside or any follow through, and it keeps on coming back here to test We did bounce off we did start this week on the 20-day moving average, almost went lower, then bounced right back up. So that is some good positive momentum to see in the stock market. But arguably, the Qs are looking way worse. I mean, we didn't really have much of a recovery besides today, of course. So if I look at the daily chart for the Qs, I mean, we're looking at over here, we're still below all the EMAs and still below all the moving averages on the weekly. Sorry, this is the daily chart. And then the next target is 582 on the Q. So we don't have to necessarily go there, but it's just, this isn't necessarily a bullish chart. And this is weighted by tech. Tech is mostly the one who's weighing the Qs, and you still have your Mag 7 kind of lagging a little bit here. You know, Amazon is up 1.62% today, but still, and you know, we did have that news of Warren Buffett. I'll take a look at that one in a second, just going over the charts and darts for a minute. On the weekly chart for the Qs, you know, we could not recover the 21 EMA on the weekly, right? So we want to stay above that. The 50 EMA on the weekly is 575. So, you know, this might be a trend reversal. Again, you have these wicks all the way up here that's kind of signaling a little bit of a top. But I don't want to jump the gun or anything because, guys, we've been through this so many times. But arguably, though, this is not the same market that we were having here since April, where we were just a breakneck rallying straight up. This is a little bit of worrisome over here, right? So it's better to just like kind of stay patient during this and not trying to shoot bullets or anything, because honestly, you can really get your head whipped back and forth over here. I mean, you have still Bitcoin just like continuing to fall off a cliff. Like we had some recovery over here, and then we fell through. And then we had some recovery over here bouncing in the 200 week, and then we kind of are pulling back a little bit here. And the daily chart, you know, not looking as bad because we are finding some support over here, but it cannot get above the 90 main. This is honestly a very bearish trend that we have over here. So we want to see the mega caps really hold up here. Now let's look at Amazon real quick. So Amazon had a little bit of a bounce today, okay? And we did get those 13 Fs that came out recently. And we had, of course, Bill Ackman and Pershing Square. They did open a sizable position in Amazon. So here's the thing. Bill Ackman, I'm pretty sure his portfolio is about $23 billion. I'm seeing like some conflicting evidence here as far as how big his portfolio is, but I'm pretty sure it's around $20 billion. But nevertheless, he has a 10% position on Amazon. And let me actually pull up the positions that Bill Ackman did. 1 second. All right, so I'm going to bring this up from rallies real quick. And if you look over here at Pershing Square to see what Bill Ackman did, we have that he did add about 50% exposure to his Brookfield position, which is a good move to do because Brookfield is doing really well. Like you want to add to strength, not necessarily to weakness, because if you add to weakness, you don't know if we can get weaker, right? So you got to be careful when you're adding to weakness. For me personally, I would not be adding to weakness. I'd rather add in the recovery. I made that mistake last April, last March, and last February, where I kept on adding its weakness, and I didn't actually recover my portfolio until like 2 or 3 months after we had the recovery, right? So yes, I was buying the dip, but the dip kept dipping, all right? We saw those memes all the time where it was like, the dip keeps on dipping, or buy the dip. With what? Like, what are you going to buy the dip with? Like, it's hard to buy the dip if you keep on thinking this is the dip, and then you keep on adding exposure, because otherwise you're going to get some margin. So it's better to manage your risk, all right? So we have over here that he reduces Uber position by ever so slightly. He reduces Google position. You know, he was buying when it was at 150. So congratulations to that position. He has a new position in Meta. So he started a position in Meta. The price was around 640. Actually, no, this is the price at the time. But he has 11% position in Meta. And he also has a 15% in Amazon. He did dramatically increase that Amazon position. So, I mean, basically, you're buying tech. Like this is not, I don't know. This isn't like a wholly diversified portfolio. Yeah, he's got 20% in Brookfield, which is a really good company and still has a lot of exposure to a lot of different industries and everything. But I mean, you're kind of buying the Mag 7 over here, right? You're mostly Amazon, Google, Meta. He's only missing Apple. He's only missing Nvidia. He's only missing Tesla and Netflix, right? But remember, he did paperhead Netflix at the bottom. I don't think he wants to buy Netflix for that specific reason, right? So there is a little bit of a difference where how much scrutiny this guy's going to go through if he buys Netflix right now. Like, let's be honest, he's not going to buy Netflix right now. So that is Bill Ackman's position. Brad Gerstner with Alternative Capital, he did add a little bit of size to some positions. He did reduce the meta position. He reduces a snowflake position, and this is probably at a loss as well. He reduced the Confluent position because Confluent is going to be acquired, so there's no reason to hold that one anymore. He reduced his hood position by about 50%, increased Mercado Libre 80%. Mercado Libre, again, is the Amazon of Latin America, right? Makes sense to add that position about 50%. So we'll see with that one. Broadcom, he basically sold out of all of his Broadcom. Now, what was his size for Broadcom? It wasn't that big. I think this is like about a 2% position. So yeah, grab. He has grab warrants. I didn't notice about that one, but that's like barely anything. Yeah, 3.5 million shares in warrants. I mean, these warrants are going to expire worthless. So this is just FU money to him. I don't think he expects that one to come back. So yeah, that's pretty much Brad Gerstner. Let's take a look at Warren Buffett. Let's see what that 13F is over here. Where is that? Rallies. Rallies usually does it with good charts over here. Here we go. So Berkshire Hathaway. Oh wait, no, this isn't that nice chart that Rallies usually has with Warren Buffett. Gemini. Elliott Capital. We'll take a look at that one a little bit. All right. I guess they don't have. Oh, okay. Here we go. Ooh, that is not. We got to zoom in a little bit over there. Oh man. Let me share in the right tab. All right, we got a little bit better going on over here. So he reduces Apple as he's been reducing his Apple every single quarter. He reduced his Bank of America. Now that was something quite new. I know he's been trimming it, but a 10% trim on his massive 10% of his portfolio, Bank of America, was kind of interesting to do. He's still holding on to Coca-Cola. He actually added a Chevron, which is probably a decent buy because energy's been up pretty considerably. He added 10% to his Chubb position. We'll see what happens with that one. He reduced the Constellation Brands by 3%, reduced DaVita by 1%. Aon reduced by 12%. Pool, okay, so he reduced Amazon by 77%. So why, hold on a second, someone's saying that they can't hear any audio. Maybe it's just you because I do have that on there. So he reduced his Amazon by 77%. Now, why did he reduce his Amazon by 77%? So there's two things that could be over here. He also added New York Times, but 13 basis point position, that's like nothing. Even Amazon before for him, he reduced by 77%. And that's kind of the reason why I'm going to point this out over here is that he reduced by 77%. So if I whip out my calculator and I do 0.19 divided by 0.7724, that means that it was originally a 26 basis point position, which isn't that big when you think of Warren Buffett. So a lot of these investors are, I don't want to say liquidating their Mag 7, but they're selling a lot of their Mag 7. It wasn't just Warren Buffett. It was Peter Thiel and it was a few other people that have, I don't want to say liquidated. Liquidated sounds like very fear-mongering, sounds like very scary, like, ooh, they're liquidating their position. But, well, I don't know. What Warren Buffett, why are you selling Amazon when it's a pretty good company? He doesn't like concentrate his portfolio massively in certain positions. I mean, if we look at Apple, yeah, it's like 22%. American Express is 20%. Bank of America. But there's like over time where he made it that big. He didn't just do it in one big tranche. But why are you selling Amazon? So my theory is that, one, this is not Warren Buffett that's doing. This is likely Greg Abel. It probably has to run by Warren Buffett's desk. But, you know, he just did at Google, basically made a double on it. He has a lot of exposure to a lot of dividend-paying companies. Less of the mega cap stuff, more of like the safe companies, right? The companies that are going to be able to weather a storm if we do go through some sort of recession or some sort of slowdown. Now, Amazon is very exposed to a recession. Why? Because a lot of the money that they make, not only in e-commerce, but also AWS and advertising, is made through other companies paying them, right? And during recession, no matter what company you are, you're going to cut your budgets in terms of advertising, in terms of infrastructure, or you're going to tighten the belt a little bit, which is going to actually impact Amazon. Now, Amazon is not a completely safe company, right? This is a growth stock wearing a Mag 7 in clothing, right? So if the market goes through a recession, which I'm guessing that Warren Buffett thinks that something's going to happen because he has about 30% of his capital in cash, then it's likely he wants to reduce exposure to Amazon, even though it's considered historically cheap. They buy things on the dip. Maybe he doesn't think Amazon is dip. In fact, he didn't really buy a whole lot of Amazon during the Liberation Day. So I don't know, maybe he wants to allocate more money to cash because overall I think he was a net seller last quarter. He wants to increase his cash position. Now, I'm surprised he hasn't outright bought Occidental Petroleum at this point, but he could be prepared to do that. If he were to take Occidental Petroleum private or merge them into Berkshire Hathaway, then that will require a lot of capital and so on. So also on top of that, Berkshire Hathaway is a massive insurance company, right? So they do need that capital as far as hedging a lot of their insurance coverage. Now, even though their entire company isn't necessarily Geico or these insurance companies, they do need to hedge their risk with these insurance policies, right? And yes, they do get premium from their clients, but they also need to have cash in hand just in case that happens. Also, he has a large stake in a lot of banks as well, right? So he has a lot of exposure to the downside in case the economy were to tank. Now, according to the Fed minutes that were received today, the economy doesn't really look like it's tanking. So, what is Warren Buffett preparing for? I mean, this guy always thinks in the long term. Berkshire Hathaway, I wouldn't really read too much into it. In fact, I wouldn't really read too much in terms of all of these legendary investors and what they're doing with their capital as far as like, hey, I should do this quarter. Because you got to remember, these guys made these moves and these were their positions as of December 31st, more than a month ago, right? So he could have re-entered Amazon. I doubt he did, but he could have re-entered Amazon. And all these people could have re-entered their positions the very next day. Very likely they didn't, but that could be the case. So take these with a grain of salt. Don't exactly take it verbatim like, hey, this is how I should act based on these legendary investors making these moves. Kind of take it into consideration, but don't really make your moves based on that. Focus more on the micro and then focus on the macro when it really matters. Does the macro really matter today? I mean, arguably the macro does matter almost all the time. The thing is that if you base all of your investment decisions on what the macro is doing, you could be acting too early or acting too late or whatever it is. It's better to focus on your companies and then react when things happen. That's usually just how I play it. So yeah, I know the audio is pretty fun. I appreciate it. All right, so let's go ahead and move on to the next segment. ACLS reported earnings yesterday, and guys, got to be honest, it was not good. I'm not going to try to paint this on a Christmas tree and be like ACLS is firing at all cylinders. They tanked, okay? So let's take a look at the daily chart and see how much they're down. It says about 17% down today, but to be honest, they opened at $92 yesterday. So technically speaking, they're down about 13% from yesterday's open, which is still nothing to sneeze at. That is a very big move in a single day. What's worse is that they pretty much opened and sliced through all of these moving averages, right? They gapped down. This is a massive gap down. They bounce from below the 200-day moving average, which is pretty much something to really keep an eye on. If you look at the weekly chart, this looks terrible, right? This looks like a massive sell on the weekly chart, rejected the 200-week, and just went all the way down. So I'm going to keep an eye on this one. I don't necessarily want to be a bag holder, especially new positions where I haven't built a full out thesis on something. And I don't want to make it seem like, hey guys, full port this company because this is a great deal now. Or it's like, oh, well, if you loved it at 91 bucks, then you'll love it at $80, right? That's not really how it works, right? Or that's not necessarily how I work. It might work for you, but I don't think that's how this works, especially when the market's at all-time highs, right? So there would have to be a material change that happens in order to bring this stock all the way back up. Now, the sellers could not bring it below the 50-week moving average, right? Or they could not keep it below the 200-day moving average. But that doesn't mean that, hey, that means this is support. Give this thing time to play out, all right? Give the thing time to play out for the market to kind of react and digest its earnings, okay? So now what exactly happened? This guy keeps on saying that my audio keeps on disappearing. That is so weird. I don't know why he keeps saying that. I mean, guys, let me know if my audio is disappearing. I'm looking at the settings on my side. They look like they're pretty fine, but someone check on that guy. I mean, I don't know. Maybe the ear headphones are messed up. But anyways, what happened on their last earnings that was of a major concern? And I will tell you what happened in their last earnings that was a major concern right here. So let me actually bring up. I'm going to bring it up. I posted about it yesterday. Man, this guy posts a lot of stuff. I got to be honest. I didn't really post that many stuff today. Yeah, I just told some people in the community like, hey, look, I'm keeping an eye on this below the 200-day moving average. I already explained most of that to you guys a minute ago with AMAT. We're going to talk about Palo Alto in a second. Here we go. So, sorry, ACLS Technologies, all right? So they beat the top line, they beat the bottom line. But like I said all the time, the market does not really care too much about your past performance. They want to see your future performance do well. GAAP EPS beat, of course, but the guidance was really what didn't do well. Okay, so they are accelerating revenue from -5% to 1%. But the guide in the previous quarter, or the estimates for next quarter, were actually $218 million. So they missed that by a wide mark. On top of that, their GAAP EPS this quarter came in at $1.10. Actually, I'm pretty sure this is non-GAAP. Non-GAAP, actually, no, non-GAAP EPS is $1.49. Their non-GAAP was 71 cents for next quarter. Their GAAP EPS is going to be shrinking, right? So when you have earnings shrink, the market hates that. Now, if they came in next quarter and they said there are $218 million in revenue, that likely would bring their GAAP EPS up and they'd likely accelerate earnings, right? But from their earnings call, unfortunately, during the earnings call, analysts were asking, because I'm sure analysts were reading the earnings or were listening to the earnings for the Applied Materials, which I've said many times that one of their competitors is ACLS Technologies. And ACLS Technologies is like more of a pure play when it comes to ion implementation for DRAM chips, right? So memory chips, SanDisk, Samsung, TSM, and so on. They basically said that we're not going to see that ramp up until the second half of 2026 and into 2027, which means that the market's got to wait, right? The market does not like waiting. The market wants it now. In fact, that's what they were pricing into the stock when it had a massive, massive rally leading up into the earnings and the excitement that happened after the AMAT earnings came out. So when those earnings came out for Applied Materials, hold on a second. When those earnings came out for Applied Materials, the stock went from like $90 all the way up here, right, to yesterday's close. There was a lot of excitement built around it. People were like so sure they're going to be earnings. Even I thought that was going to be the case. And then they came out and SHIT the bed, right? The market hates that. The market hates it when you don't beat earnings or when you don't give good guidance, but it hates even more when you are shrinking earnings. And that is literally what you're seeing here today. Now, what's going to happen in a few quarters? It's very likely that they are sandbagging their earnings for next quarter, their earning estimates for next quarter, and also their guidance for next quarter. They've actually beat earnings every single quarter since they went public. For the most part, actually, no, the last 17 quarters. So they've basically been public for quite some time. But the thing is that they missed by about $30 million. So even if they sandbag that guidance and still come in at $210 million, it would miss the original estimate. Now, if they come in and beat the next earnings, then of course the stock's going to go up. The thing is the guidance for the next quarter after that. And the market already heard from the earnings call that management was giving, which they're kind of like not really giving a real answer about, was that they need to wait for the ramp up. So they need to wait for these manufacturers. They need to wait for these memory companies like Micron, TSM, and Samsung that are actually fabricating the chips. Now, TSM isn't designing them, but they are fabricating a lot of memory chips with these other companies. They need them to go through building all the chips so that way they can order the new machinery and so on, right? So this is like the second degree of the ramp up for memory. You're already seeing other memory stocks doing very well today. Micron's up about 5% today. SanDisk, even after their offering yesterday, is basically flat on the day. And ooh, look at that. SPY is pulling back a little bit. Very interesting action over there. But the thing is that this story is going to take a little bit of time. So what am I going to do with my position? So I already said to a few people, look, I want to see how this week pans out. All right. I don't want to be a bag holder. I don't want to hold on to this and keep on buying down or hold on to the position. Before the earnings, this is like around 5 to 6%. I did increase the size a little bit. Unfortunately, it didn't serve me the right way. So yes, this is weighing down on my portfolio today, being that it's down 20%. But there's a reason why we manage risk by associating position size, right? If you were long a lot of calls into this earnings, you are feeling the pain today. I have some calls in it, but most of the position was in shares. I usually do like a 85-15, 90-10 when it comes to shares and options, right? So especially in today's market, do I really want to press the gas on a lot of stuff? I already showed you at the beginning of the podcast, like, look, we have a little bit of hesitation with the market to keep things afloat. This is a massive pullback from the top of the day or for the high of the day. Kind of want to wait and see what's going to happen with this one. It doesn't hurt to be patient. You don't need to make a move right now, but I'm not going to sugarcoat it. This is not looking good, right? This is looking pretty bad. Things that I've listened to, right? So I've listened to a lot of earnings this quarter so far. Most of my earnings are pretty much done for this quarter. This wasn't the best. So now let's bring it over to Palo Alto. Palo Alto's earnings actually weren't that bad, right? But they still brought the stock down 7.5%. So if you're already bringing a lot of these software stocks down after their really good earnings, oh, look at that, IGV pulled back again. There were a lot of companies that reported earnings. Their earnings were actually good. Amazon had good earnings, but they brought the thing down. Google had great earnings, but it's trading below them when they reported. Meta had really good earnings. They faded the entire thing. We're going to see with NVIDIA next Wednesday. We're going to see Netflix had good earnings, but then they pulled back. Apple had actually a lot better earnings, but they're trading higher than where they were for those earnings, but this is more of a safety trade. Astera Labs, I mean, those earnings weren't that great. Applied Materials are really good earnings. They're trading higher, but they did triple beat on their revenue, on their earnings, as well as their guidance. So that's the reason why they're still trading higher today. So there's a bit of fear for companies that are not outlandishly beating top, bottom line, as well as guidance. In fact, AMD had pretty good earnings too, but now it's trading a lot lower than where it was before their earnings. Arista Network had really good earnings, but look where it's trading at. It's trading near where it was when they reported earnings. They were up very high. I think they were about 20% after those earnings. And look, it faded the whole move. So this isn't really a forgiving market to be going deep in like calls or pressing swing trades right now. I'll be a little bit careful. I'll be a little bit cautious in the market right now. I mean, obviously, we could just have like one day go by and the market could swing all the way back up. But, you know, you need some recovery in this, right? This is, I don't know, this 100-day moving average loss could be pretty ugly if we were to lose this one. So I'm going to keep an eye on that one. Danielle Shea will give a better indicator of where she's seeing the market as far as the short-term trader goes. So we might be able to hear some news from her tomorrow when she does come on. So tune in tomorrow. We're gonna have Danielle Shea. She appears on CNBC as well as Fox Business, a few other firms. And she does run a pretty good desk. So we're gonna get her expertise opinion on the way she's seeing the market. Let's take a look at the S&P 500 sectors. Here we go. All right, so financials are doing pretty well today, which is pretty healthy. Consumer discretionary, Tesla and Amazon are doing pretty decent today. Tech is doing pretty decent today. Industrials is pulling back. So whatever was originally leading the market is actually finding a little bit of a pullback right now, which is good to see, right? I mean, materials are still pretty up there. Utilities are pulling back, which is good news to see for risk on. XLRE or real estate is up, which is good to see for risk on. Communications, Meta and Google is basically flat today, but at least it's not down. Healthcare is down, Staples is down. So yeah, this is still appears to me that this is a little bit risk on, but not like outlandishly bullish, like, hey, we are so back. So you got to kind of be careful a little bit over there. So yeah, what's going on, Nick? How are you? So yeah, guys, let's just kind of sit on it, right? We don't need to make any moves today. I didn't really make any moves today. Just sitting on some hedges that I still have on. Gonna wait and see what's gonna happen with the markets. Sitting on the ACLS position, I did cut the Silicon Motion position yesterday, mostly because, I mean, I should have waited with that one, but closed it at around break even. Doesn't really seem like the market that I want to open up like massive positions in, and sitting at about 5 to 10% cash. So gonna wait to make a decision there, and we will see what happens. So Fintech, let's take a look at the Fintech sector real quick over here, and I'll find some coverage of some Fintech companies that reported earnings yesterday. Oh, wow, Klarna faded the entire move. That's interesting. Shopify is still up 7%, which is pretty good, but it's got to get above these moving averages over here. Toast, they actually were up a lot after those earnings, but they pretty much became toasted. But yeah, Fintech looks like it's bouncing a decent amount over here. Robinhood went red again. Interesting. But yeah, a lot of it is going to be tied to crypto. I wanted to see something over here real quick. Oh, look at that. Hassett actually was interviewed this morning, but there was some coverage on, hold on. All right. So yeah, we're going to go over the Palo Alto earnings. Actually, Dan has reported on this morning. He obviously is a Palo Alto bull, but he's been following a lot of cybersecurity for a while. And I am bullish cybersecurity, just unfortunately not right now where I can buy the major dip in some software stocks. So I'll play this for you real quick, guys.
Dan Ives, he joins us now from Wedbush with what to expect this evening and what's been taking place in that group. It's good to see you.
Great to see you.
So, thing that's been going on.
Yeah, I think part of it is just this software, right? I mean, the view is that can cyber be disintermediated by some of these tools, whether it's Anthropic or some of the, really the startup tools that are coming from an AI perspective. To my point is, look, coming into this year, all of our checks are showing cybersecurity should actually see anywhere between 300 and 500 pip acceleration. I think some of that is because as you see the AI use cases deployed, you look at Palo Alto, they don't acquire CyberArk if it's not for AI. CrowdStrike, all the stuff George and the team are doing. I think this is one, I get it's a guilty till proven innocent, but cybersecurity, this is going to be, I think, it's a moment that inflects, and ultimately it's going to be a huge growth area for the sector that I don't think is being factored in here. Right now it's being viewed as a headwind, but tonight it's very important to hear from Nikesh. He has a great perch.
I mean, part of me wants to say, well, how can you have checks on things that we don't really know what we're checking for yet?
Sure.
Like, we don't know what these other tools are going to do and how they're going to disintermediate certain industries until we actually see it.
Yeah, I think to even get more granular, typically going into an IT budget cycle, let's say about 5 to 8% of maybe that budget is what I'll call cybersecurity related. Now what's happening, because so many more of these comprehensive solutions, AI platforms end to end, I'd say about 70% of IT budgets have an AI sort of angle. Cybersecurity is now not 5 to 8%. You could argue from everything we're seeing, 20-25% of now the potential budgets that they could go after. So when I look at Palo Alto, CrowdStrike, Zscaler, like Scott, I think this is one I know we've talked about a lot in software, but cybersecurity I think is being mispriced that AI is a headwind, where in fact I think it actually is going to change the view of the sector for years to come, as well as also I think it's going to be a huge catalyst for M&A.
I mean, you've looked at Palo Alto specifically, I think, on this very program and declared it, in your words,
table pounder,
right? I mean, you still believe that, or is in some respects the jury still out even for you? You want to see what they deliver tonight, because the stock's had some upset in the past around earnings. It's not like this thing just goes straight up.
Yeah, no, look, there's 3 reasons why this is, I view it as double table pounder, because the CyberArk deal will be viewed as the deal that changes Palo Alto. I think what Nikesh did there, you're talking about $25 billion, I could argue is going to generate hundreds of billions in the future of market cap, ascension, given what that gives them a full end-to-end platform. 2, if you look where they play, just like CrowdStrike, we are now getting to an inflection point where you are going to start to see AI. I think 25% of the deal flow ultimately will be positively influenced. That's not factored into the street numbers, sentiment super negative, and that's why, to me, Palo Alto, CrowdStrike, those are the ones that I view as just names that, not even just in cybersecurity, but overall tech, are 2 of the top.
I mean, I mean this respectfully. I truly do. I feel like you're a defend first, ask questions second kind of an analyst, right? Yeah. The companies have an upset, very quick to come out and defend the name, defend the price, defend your call, et cetera. You afraid you're missing something on any of this stuff?
And look, it's valid, Scott. What I would say is that, but that's all the work that we do in talking to the hundreds of resellers, partners, all the checks, all the travel. It's the one that gives me the confidence to where if there's a quarter that we miss, or there's some nuance where the stock's down, the reason I defend is because all the work that goes into it, and I know that I feel like based on our thesis and what I've done 25 years, I could defend it despite maybe sort of a speed bump or tripping over the shoelace. That's why I think sometimes, especially on some of these names, you have to be able to see forest through trees. That's all the work we do.
So, I mean, he's got a point there, right? So the market does a lot of this selling a lot. Like they've gotten pretty crazy with all the software they've been selling. I mean, if we take a look at some of these software charts, a lot of them are outlandish, right? So a lot of them have had massive pullbacks. And then I will get into my thoughts around that one. But first, let's just take a look at the numbers over here for Palo Alto. Shout out to Stock Market Nerd. He posted, I mean, you guys already know Stock Market Nerd. He is elite with posting a lot of this stuff when it comes to earnings. I don't know how he pumps all this stuff out so quickly. He was doing it way before AI too, which is insane. But if we take a look, actually, let me make this a little bit bigger. Oops, that's too big. All right, so slight beat. You know, the market is just unforgiving when it comes to beating estimates, right? So, but again, this is previous quarter, right? This is the quarter that already passed us. So I don't think the market really cares too much about what happened. All right. Guidance, all demand guidance raised due to large M&A closing. All right. All profit margin guidance lower due to okay. So they are concerned about the merger and acquisition, and what Dan Ives was saying, which is true, they announced it a couple of months ago, was that they're acquiring CyberArk for a considerable amount of money, actually a lot of money, right? And Palo Alto does this a lot. They acquire large companies to become a massive cybersecurity platform. I would expect more of this moving forward. This isn't a company that is growing at like 30, 40% organically. This is a company that is acquiring most of its growth. Now, cybersecurity is on a major TAM, right? So this TAM is growing at like 20, 30, 40% CAGR all the way through 2030. But do they need to acquire all this growth? I think this is the reason why the market's a little bit concerned, is that why do you have to keep on buying your growth? Now, CyberArk isn't necessarily within Palo Alto's realm. CyberArk is more of identity security or identity and access management. So validating your identity, making sure you don't have anyone that's trying to conceal themselves, any hackers and so on that are trying to use bogus credentials to get into your database, whatever it is. That's what Palo Alto does, right? And that's what CyberArk does, and they do a lot of authentication between the applications or the systems through AWS or through Azure, Entra ID, and so on, or Active Directory, what it used to be called. That's a lot of what CyberArk does, and Palo Alto is putting that into their platform to be able to have more offerings for clients, to be able to cross-sell and so on, to become a larger platform. But that costs money. And all that money is going to take a hit toward their margins. And that's clearly what you saw last quarter. And the market isn't so fearful as far as this particular one, but they're already fearful of cybersecurity and software in general. So if you bring up something that the market needs to worry about, they're going to sell you off. I got to be honest, even after the sell-off, Palo Alto isn't the cheapest company around there. They're trading at around 9 times, 10 times EV forward multiple. Actually, if we take a look at the fiscal AI, I'm going to go ahead and share this screen over here. Oh, wow, I started a little bit late today, so I'm running a little bit late. It's all right. We'll stay on it for a little bit longer. If we go to Palo Alto, let's look at their financials. Let's look at their ratios. By the way, this is Fiscal AI. Shout out to Fiscal AI. Braden's the man. All right, so let's take a look at the forward valuation. When it comes to software stocks, you always want to do the forward valuation, not the trailing valuation, because you have a pretty good idea of where they'll be going in the future due to their remaining performance obligations. So don't look at price to earnings, because it's not usually the best metric when you look at software companies, considering that they're basically breaknecking the profitability segment until they become mature, like a Microsoft or something. So forward EV sales is the one you want to look at. Today, they're trading at about 8.7, which is good. It's a lot better. But historically, though, it is still pretty expensive. So if I look on the historical level, I look at the median, we are sitting still above the median for that. So if I look at the average, we're still trading more expensive than the average in the last 10 years. So why are you paying a higher multiple for Palo Alto? I mean, that's my thing, right? But obviously 10 years ago, they were not a profitable company. They weren't a cybersecurity giant. They weren't making billions of dollars each quarter. So it is arguably the better company. But even after this pullback, they're still expensive, right? So do I want to own Palo Alto? Probably not. But this company is going to be around in 5 or 10 years still. They're not going to go anywhere. So that's a risk you take with buying a cheaper software stock, that you have that risk that it's something new. Now, CrowdStrike, on the other hand, I actually have a dashboard over here, and I got one for cybersecurity. Here we go. Security, as far as forward EV sales go, Rubrik is trading at 6.7, and Rubrik is growing at 50% year over year, and their free cash flow margins are 21%, but they're not profitable, okay? So I'll give it that. CrowdStrike's trading at 17 times. Super expensive even after this sell-off, okay? I don't even think they had a sell-off, but they pulled back, right? So that's the problem here, is that I would buy CrowdStrike, but they're still ridiculously expensive, right? So they do have 25% free cash flow margins. They're on the brink of, some quarters are profitable, sometimes they're not, but they are a cybersecurity platform. They're becoming one, right? So this is probably something better than a Palo Alto if you want to buy organic growth. Sentinel-1 3 times. Guys, don't be fooled by this. This company, I think this is adjusted free cash flow margin, and the revenue growth is 25%, and they're not even profitable. So you need to have like a really good bull case in order to buy this company, like something that a lot of people don't know, or you're shooting for an acquisition. Zscaler is trading at 7 times. All right. So probably the better deal that you're getting than buying a Sentinel-1. This is a secondary leader when it comes to cybersecurity. Zscaler does historically come down here and bounce up according to its charts, but all of software is getting decimated. I would argue that the one that's going to bounce back the most when software does come back is most likely to be Palo Alto, most likely to be CrowdStrike, most likely to be Rubrik. These are leaders in the industry. Fortinet is a little more of legacy and not really growing that strong, but is a much more mature cybersecurity company. Trades cheaper than Palo Alto, but there's a reason why it trades cheaper than Palo Alto. Its free cash flow margins are not as good as Palo Alto. Palo Alto is still innovating, right? So kind of a trade-off here. Is software the place to be right now? Would I buy software? No, I'm not buying software. I know a lot about these software companies, but I don't want to buy these software companies because I don't know where the bottom is. I could have told you the bottom was a month ago. I've talked about this so many times in this stream. You could have said the bottom was last week. The bottom was 2 months ago. The bottom was a month ago. And it would have looked like a good discount compared to what's trading a few weeks before that. But we don't know where the bottom is. So it's better to wait until we get that recovery to make that decision. What's the rush to buy now? If you're holding for maybe a year or something, you better not be buying now. Because if you're buying now, then you're probably a much better trader than I am. So kudos to you. If you're buying for 5 years, well, what's the rush to buy right now? How do you know when the bottom is, right? I think the question is, should you buy all at once if you're buying for about 5 or 10 years? And if the answer, if that really is what you want to do, if you want to own for 5 or 10 years, then why buy all at once? Why not just DC on the way down if that's prerogative? For me, I'm not going to buy. I'm going to stay away from it because these charts are horrendous. So I think that about wraps it up for today. Let me just take a look at something real quick here. I just want to, hold on. Yeah. All right. So we have a few earnings that are coming after hours today. Let's just go over these real quick before we sign off the stream. And we are looking at, we are looking at some earnings after hours today. We have Oxy Dental Petroleum reporting after hours, DoorDash reporting after hours, Carvana reporting after hours, Fig is reporting after hours, which would be very interesting. Booking.com is reporting after hours. I got to be honest, this is a phenomenal company. If I had a long-term portfolio that I was looking to add to right now, I would add this company. This is a phenomenal company. They are not going anywhere. They own basically they're basically the travel industry for Europe and starting to edge into the US. This is a great company for a long-term hold. They're likely not going to split. I mean, they've interviewed the CFO of the company, the previous CFO of the company, and he said that he is not looking to split anytime soon. So I wouldn't really count on that. I mean, maybe they will, but I don't think they're going to be splitting their shares anytime soon. Cheesecake Factory reports, eBay reports. I don't know what the deal is with eBay. It's actually been on quite a good run lately. I don't think I'll ever want to own that stock. I don't see any upside in it long term. I think they're going to get sliced and diced by Amazon. But I mean, nothing really big reporting after hours today to keep an eye on. I would really just say Carvana, maybe. Let's see if that dumps another 5 or 10% after earnings. Are their financials bogus? I don't know, guys. We'll see. We'll see. But yeah, Zeta is not reporting after hours. Zeta is a software company. That is correct. And that is not being spared in this sell-off that we're seeing right here. So going to continue to monitor the situation with that. Looks like the markets have recovered a little bit, which is great to see. It's always good to see the markets recover from whatever scare might be, because you do need that pullback in order for the next leg up. So we'll see what happens at the close today. All right. So thank you for tuning in, guys. Tomorrow we're going to have a special guest on. Just need to coordinate some timing with her. I'm going to get the take on a trader out there. And yeah, going to bring